welcome to Prime Property, your weekly real estate reckoner. I'm Nayanatara Rai and this is what we have on the show today. We go commercial on our tip of the week segment. The commercial market burdened by high vacancies, with 6 Indian cities being among the 10 worst of office markets in all of Asia. We find out if this is a good entry point. Developers say they will raise prices despite unsold inventories being at lifetime highs. Prime Property finds out why developers are not resorting to price cuts to bring buyers back to the market. On Property Doctor, we get 99 acres to answer viewer queries. Commercial real estate, known to be an indicator of an economy, has been in the throes of a major slowdown across the country. The big cities have been left with a glut of office space that's pushing up vacancy rates. Cushman & Wakefield says vacancy rates in Mumbai and New Delhi have topped 20% and are the second highest in Asia after Chengdu in China. Jones Lang LaSalle says prices of commercial real estate has tanked by 35 to 40% since the start of the global financial crisis, but insists prices have bottomed out in most cities. So, on our tip of the week segment, we decided to find out if this is a good entry point for investments. Here's my conversation with Jones Lang LaSalle.
What we've seen is since the peak of the Indian real estate market, both commercial and residential, the peak was third quarter 2008. If it put 100 rupees in commercial in third quarter 2008 in cities like Bombay, it would have been around 60-65, and in residential anywhere in the country, it would have been at around 130-140. So what we believe is the commercial markets in most parts of India have bottomed out. This is definitely a good time for high net worth individuals to get in and invest in commercial real estate. See, today if you're looking at commercial investment, one can look at 4 different types of investment. Either you buy a commercial property directly, second you buy shares of a commercial developer, third you invest in a fund which focuses on commercial property, and fourthly everyone today is talking about REITs. It's expected to kind of to be rolled out in the next few months. But as of today, what we are seeing many HNI investors do is buy direct commercial real estate.
But why should anyone right now, in the midst of this slowdown and high vacancy levels, actually invest in commercial real estate over residential real estate?
See, annual yield in residential properties are anywhere between 2 to 3.5% across the country. In commercial today, one can get returns anywhere between 9 to 11%. That's one. Second is the potential of commercial office space growth in the country. Today, if you look at just New York, Manhattan as a city, the office total stock is 450 million square feet. If you look at India, the entire country, all these large cities put together is less than 375 million square feet. It just shows the growth potential for office space in the country. See, we believe from a capital appreciation point of view, definitely across the country we are going to see a considerable amount of capital appreciation for commercial properties, mainly because from the peak, like I mentioned before, it has corrected.
And are we in the midst of a buyer's market? Can investors actually get good deals and negotiate?
Yes, commercial real estate, except in Bangalore today, where the prices have come back to the old peak of 2008, across the country, commercial real estate is available at anywhere between 55 to 80% of what it was during the peak. So definitely a buyer's market, good time to go do a deal. Many tenants today are using this as an opportunity to move into either cheaper locations or consolidate within one premises, or also looking at renegotiating with existing landlords.
But are you right now referring to large corporates and IT companies here, you know, that typically book large office space?
See, today what we are seeing is many developers who used to sell larger office space units, bigger floor plates, today are dividing those larger floor plates into smaller units. Today, a small investor can even look at buying a 500 square feet to 1000 square feet of office space. So that's bringing in a lot more new categories of buyers. So today we see professionals like chartered accountants, stockbrokers, lawyers, even doctors investing in office properties across the country.
But then wouldn't these doctors, lawyers, CAs, etc. be using the commercial real estate for their end use? Is there a pure investment opportunity here?
We're seeing two trends. One, professionals buying it for their self-use. Two, executives, senior corporate executives who would want to set up something on their own, just investing in it. And third, people are looking for a steady rental inflow by making sure there is a tenant in the property.
Okay, let's talk about do's and don'ts now. What on your list will be the 3 do's for investing in commercial real estate?
See, if you're looking at office real estate, obviously one needs to look at the capability of the developer, the kind of projects he's done before, the kind of quality of finishes, the way he manages his property. One needs to look at the various expenses involved in a commercial property, whether it's property taxes, whether it's maintenance, whether it's insurance. The investor should also look at refurbishment, refinancing, re-tenanting potential of the property. And above all else, the most important, he needs to make sure the building is of sound quality and there are no legal issues. One should make sure that you have done your due diligence on what exactly is going to be your property tax. Property tax varies in different parts of a city, different parts of the country. So that due diligence has to be done before one invests in commercial real estate.
You just said investors should be careful about refinancing. What exactly does that mean? Can you elaborate?
Refinancing is something, again, there have been properties where the existing landlords had taken at a high interest rate. There could be banks, financial institutions who could be willing to kind of refinance it at a lower rate. That opportunity also needs to be looked at.
Now let's discuss the don'ts of that do's and don'ts list. What are the top 3 don'ts for investing in commercial real estate?
See, the 3 don'ts is not to have a herd mentality. To make sure you think slightly contrarian. Keep a very close watch on vacancy. And third is invest in a property which is amongst the top 10 buildings in that micro market. Don't go after the 25th best building in that particular micro market which one is looking at.
Ramesh, you've discussed office space. What about retail properties? What's your advice on that front?
Retail, the advice would be to look at high street retail if you're looking at investing in retail properties, not to look at malls, because any mall in the country which has been sold in bits and pieces has got into trouble. So advice is to look at high street properties.
So that was our check of the commercial real estate market and how you can plan your investments. Hope those were useful tips. Now into the residential property market. We're perhaps in the midst of one of the worst ever down cycles, with developers sitting on lifetime highs of unsold inventories. One would imagine builders would resort to sharp price cuts to boost demand and lure buyers. But that's not the case. As Manasi Gilani reports, developers say their hands are tied and they aren't in a position to bring down prices.
Buyers are deferring their home purchases, convinced that a steep price correction is in store. But developers insist that it's going to be the opposite. Yes, you heard that right. Developers say that it's going to be difficult for them to cut prices. CREDAI, the developer body, blames it on inefficient governance, tax regimes and tight monetary policies.
Mere focusing on efficiency can change scenario in housing industry and even growth in economy, because currently we are suffering due to inefficiencies at all levels of governance, whether it is corporation, state government or central government. Estimate is 1,25,000 crore worth of investment is stuck only due to environment clearances. So this is huge.
But the buck doesn't stop only at delayed approvals. CREDAI also blames the complex and a high tax regime. It says at most times, buyers are caught unaware of all the state and centre duties and their overall burden on the final property price.
See, 30 to 37% across the country, and in cities like Mumbai due to this fungible, more than 45% is the component of tax, direct, indirect taxes, revenue, development charges, stamp duty, etc. to sale value, which is huge, and that is ultimately burdening consumers. Mumbai, we have to pay premium, hardship premium and fungible FSI premium. Now this is costing 20% of sale value. So though it is revenue to corporation, it has ended up in escalating prices. It has obviously made housing costlier in the hands of consumer. Every state government we saw during last budget increased their revenue expectation from real estate by increasing guideline rates or ready reckoner rates, stamp duty rates. They levied additional VAT, then some places LBT. So they are taxing this industry to earn fast buck, because you can't get your plan approved without paying that. So it's easy money for governments. But it harms interest of consumers. It makes housing dearer, costlier, and I don't think, because efficiency of money in government we know, it really helps. So it is very, very unwarranted that state governments really go all out to earn revenue from this sector.
According to 99acres.com, prices since 2009 have risen by an average of almost 50% across the country, and that includes the suburbs too. Here's how the prices have appreciated in Mumbai's suburbs, rising almost 18 to 25% in the areas since 2009. And here's the price movement in National Capital Region since 2009. The NCR is often called as the speculator's paradise.
Our request to all policymakers, and especially it is election time, so we want all political parties to include in their manifestos certain things which are definitely in public interest. And the most important is, how do we make governance efficient? Corruption free, transparent, efficient governance. Conviction at the level of parties or people in government can make things happen in the interest of people of this country. Currently, real estate development contributes 6% to GDP. Mere becoming efficient can make it 12%. Mere efficient system can double contribution of housing industry to national economy. Revenues will come earlier. There will be so much more employment generated, so much more deliveries, and so much more people will get housing.
Experts attribute the price rise seen between 2010 and 2012 to a decently healthy buyer interest. But that's far from the case now. Cash-strapped developers say they have no choice but to pass on the burden of higher input costs to consumers and hike prices to make up for the stuck investments and inadequate bank financing. And all this at the time when the demand at the best can be called muted. Rai says in Mumbai alone, there's a sharp 40% dip in new projects. Prime Properties advises bargaining hard for a good discount. We are in the midst of a buyer's market, and the negotiating power is with the consumer. Developers are stressed, so sit across the table, get some good discounts, and get developers to throw some freebies at you. In Mumbai, Manasvi Gilani.
So whether you choose to invest in commercial or residential real estate, remember, developers' chips are down, and this is the time to drive home a good bargain. On that note, we're going to slip into a short break. On the other side, we get 99 acres to answer your queries. Stay tuned.